looking ahead and also recognizing the significant amount of equity that is available and intended to be deployed in expectation of stabilized interest rates, that this combined with the fundamentals in the market discussed earlier is really creating an exciting long-term opportunity for investment.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest this week is Bryan Connolly, Chair of the U.S. Real Estate Practice at DLA Piper. Bryan is here to share findings from DLA Piper's recent State of the Market survey, as well as his thoughts on what's shaping the REIT and commercial real estate space today. Bryan, welcome to the podcast.
Thank you, Sarah, for having me.
So, Bryan, what are some of the broad themes you're seeing in terms of evolving sentiment among commercial real estate leaders today? And what factors do you think are influencing that sentiment the most?
Yeah, at a high level, what we're seeing is significant rebounding optimism, in particular looking back over the past 2 years, though tempered by the uncertainty in the market and the global stage on so many matters right now. We had a really interesting opportunity in the DLA Piper State of the Market survey this year, as I think we annually reach out to our clients and other market leaders in commercial real estate to ask a number of questions gauging market sentiments, investor interests, capital flows, et cetera. And we do this in the first quarter of each year. It's one of the great opportunities we have at our firm, and that DLA Piper represents a number of the leading institutions and private equity funds, family offices, and sponsors in real estate, and gives us a great window into what's happening in the market. So this year, we sent our survey out in February and March in the first quarter, as we usually do. And as we were starting to tabulate the results, we had significant trade policy changes and a lot of tumult in the markets that emerged in the second quarter. And at first, this was something that seemed like a real quandary for us, because we were appropriately recognizing that some of the data we had collected in the first quarter may feel stale. Like, we were hearing that from our clients. It seemed like so much had changed in April and in May. And what we realized is it actually gave us a really interesting opportunity, in that we had a snapshot of sentiment among commercial real estate leaders right before the significant trade policy announcements in April. And that gave us the idea to go right back to them again in May to ask some of the same questions and get a snapshot 2 months after, as so many investors were thinking about what do these policies mean. And so one of the exciting things about our State of the Market report issued this year is that we were able to shed some light on the question many investors are asking is, what do all these policy changes mean? How have they changed the commercial real estate market? So what we found, by comparison, in our 2023 State of the Market survey, 86% of our respondents were bearish in the bullish-bearish question. Move forward 2 years, in our first wave, in our Q1 outreach as part of the DLA Piper State of the Market survey, we had a significant increase. That 86% bearish went down to 48% bearish and matched by 52% bullish. Roughly equilibrium, a clear upward trend. When we went back out in May, we had a step back where our respondents were 66% bearish and 34% bullish. So what does that mean? We still have a significant upward trend from where we were in 2023, though really tempered by all the uncertainty and policy changes that have impacted the market in April and in May.
Great. And can you talk a little bit about the upward trend that became evident in your survey results regarding confidence that equity capital will be more available in the coming year?
We do see a number of data points in the survey that show we already have an uptick in transactional volume, but in particular sentiments for further uptick. One of the questions we asked is investors' view on real estate equity commitments in the next 12 months. 48% of respondents expect that commitments will be up this year. 29% expected no change, and about 23% expected them to be down. So that's a real significant upward optimism on an increase in equity investment this year.
Great. And why would you think it's important for investors to focus on the commercial real estate fundamentals right now instead of listening to all the noise that's out there in the market?
It's a great question. When we asked our investors why they were bullish, the number one reason that they came back was strong fundamentals. That was what 31% of our respondents said, compared to the 9% change from back just last year. And I think that's because fundamentally it's difficult to control all these different variables. Because when we asked the verbatim questions, right? What has you excited? What has you apprehensive about the next 12 months? The column of apprehensive responses, the most frequent word used in different contexts was uncertainty, general uncertainty as it applies to interest rates, political uncertainties causing trepidation, increasing uncertainty among foreign investors, and other responses such as that. I think in times of uncertainty, I think that wise investors focus on what they know, what they can control. And I think that's why relying on fundamentals has become such a driver.
And Bryan, do you think there are certain REIT sectors that are seeing sustained investor confidence and interest in this environment?
Yes. In particular, the asset classes that we're seeing the most interest in are multifamily and really housing generally, followed by data centers and then logistics and warehousing. The asset classes that our respondents found most attractive in the next year, 51% identified multifamily, 44% identified data centers, and 38% identified logistics and warehousing. Interestingly, we've seen this uptick also in Class A trophy office. The trends in return to office continue to increase. Office leasing is improving, but in particular in the highest quality buildings. And so more and more investors are starting to look forward and into that asset. Again, that was 27% of our respondents.
Turning to development, what sort of trends are you seeing overall? And can you talk a little bit about what it takes to get a successful project off the ground today?
Sure. It's been interesting. I think if you looked to the decade before the last 2 years, the challenge in developing commercial real estate fell in, the competition and obstacles to assembling land, acquiring sites, obtaining entitlements to develop great projects. What we've found flip in the last couple of years is that we now, and I should say, once you achieve those goals, we had such healthy debt and equity markets. It's usually a very competitive process in obtaining the financing to develop basically any type of asset class, in particular with the great rent growth we saw in that period, was almost always achievable. What we've seen the last couple of years, unfortunately, as costs have risen, rates have risen, in certain asset classes, rents have declined, is that you have great entitled projects that just don't pencil out. So that's been the main challenge. Is in particular obviously the cost drivers and interest rate costs are significant, but the expectations for return on cost by equity investors have, significantly increased as other investment opportunity rates have also increased. And so that's just made it harder for developers to obtain the amount of equity they need to develop the projects that they've entitled.
And given that trend, do you think we might see more acquisitions or dispositions in the REIT space going forward?
Yes. What we witnessed really over the past 2 years, both with projects facing challenges with developments, and also we've had, as you know, a number of assets in the industry looking ahead to this, wall of maturities that have had to transact to deal with the challenges in refinancing existing assets, is that we have had significant repricing in the market. And I think we've had a lot of just capitulation and recognition of where pricing will be, which has given buyers and sellers comfort in moving forward. One of our questions in our survey tried to assess the extent to which investors feel that the commercial real estate market has bottomed out. 50% of our respondents agree that the market has bottomed out. 25% were neutral on the question and 25% disagreed. And so that's another big upward trend in showing that effectively a majority of investors think that the market has reached bottom. Many shrewd investors are not trying to perfectly time the bottom, but they want to transact when they're in that plane. And I think that's what we're seeing more and more, is investors being more comfortable making these investment choices where pricing is now.
And Bryan, we've also seen a lot of joint ventures used by REITs to fuel expansion. What would you say makes a successful joint venture, and do you envision more?
I do. Look, the best joint ventures are between sponsors and investors and partners who are aligned in their vision for development, their vision for ownership, their strategy, their cultures. And so we see the best partnerships, the best joint ventures are between people who have that compatibility. You'll see great partners continue to do deals with each other that follow on initial deals and become programmatic. It's just such an important vehicle for getting equity into the market, to both do ground up development, to do value add, and just generally to transact on stabilized investment opportunities as well.
And are particular REIT sectors more likely to do joint ventures than others?
Yeah, I think it's interesting. We see, in particular, we find private equity investors, right? This is what is the main focus in private equity funds that are deploying their assets with sponsors and joint ventures. Also, a significant increase in family office investment being deployed through joint venture investments, and then followed third by non-U.S. investors seeking exposure to U.S. commercial real estate. An attractive method is to do it through joint venture partners.
And Bryan, before I let you go, are there any other REIT-related trends or developments that are particularly interesting or pertinent to you right now?
I think the biggest trend is the continued emergence of some positivity and some excitement about what the future may hold. Again, among some of the responses in our survey were people expressing the ability to acquire some of the best properties at even 50 to 60% of replacement costs. People recognizing that troubled times yield new opportunities, right? Just need to be sharp enough to sift through what we have and find the most valuable opportunities. People recognizing Investors recognizing that the lack of new multifamily starts present great opportunities for experienced developers, and also recognizing, as I mentioned a moment ago, that there's a sense that the market has bottomed out and new pricing has been established. And so looking ahead and also recognizing the significant amount of equity that is available and intended to be deployed in expectation of stabilized interest rates, that this combined with the fundamentals in the market discussed earlier is really creating an exciting long-term opportunity for investment.
Excellent. Bryan, thank you so much for your time today.
Thank you, Sarah. It's been great talking with you.
And if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.